MAC just revised inflation forecasts upward, and your cash yield is quietly evaporating. If you are chasing gold at these record highs for your SRS account, you are building an income vacuum that will drain 3,300 Singapore dollars out of your retirement budget every single year. Today, I will show you why a seemingly safe 20% gold allocation is actually the most expensive insurance policy your portfolio will ever buy. The arithmetic of the heartland is brutal, and ignoring it will cost you dearly. The Monetary Authority of Singapore delivered a significant signal recently. The headlines focus on the policy band holding steady, but the forensic reality is buried in the inflation forecasts. MAS core inflation has been revised upward to a range of 1.5 to 2.5%. Meanwhile, the one-month SORA rate has moved to 1.18%. This creates a real yield squeeze. For a retiree relying on cash flow to survive, the arithmetic is completely unforgiving and requires immediate attention. If your money sits in a product yielding less than 2.5%, you get poorer in real terms every time you walk into a FairPrice. Many investors are panicking into gold right now. They see the record highs on the charts and they think they have finally found a safe sanctuary for their capital. But chasing these record highs is like paying 10 Singapore dollars for a simple kopi. It is a luxury that actively drains your daily grocery budget while pretending to protect your wealth. Here is the uncomfortable truth about the Spider Gold shares. Currently trading at 536.20 Singapore dollars. Gold is absolutely not a sanctuary for an income-starved retiree. It is a completely non-productive asset. It pays you exactly $0 in rent, $0 in dividends, and $0 in interest. The perceived safety is entirely an illusion when you realize that every dollar parked here is a dollar that refuses to work for your monthly living expenses. When you swap a high-fidelity allocation for gold, you are firing your most productive workers. For a 58-year-old managing a 300,000 Singapore dollar SRS account, a 20% shift into gold displaces 60,000 Singapore dollars of capital. You lose the 6.33% yield you could have had from DBS. That displacement creates an annual income vacuum of 3,300 Singapore dollars. That is 2 months of groceries and utilities for a typical household in Bedok or Jurong, completely gone in the name of hedging. When the macro environment shifts, forensic discipline demands we look for a fortress balance sheet first. If you insist on playing the gold theme through equities rather than bullion, you likely ended up looking at CNMC Goldmine. On paper, CNMC is untouchable. With an interest coverage ratio of 363 times, they are the uncle who owns his HDB flat fully paid and keeps 6 figures in the bank. He is safe, but at a stock price of 1.51 Singapore dollars, you pay a king's ransom to sit at his table. Looking closely at the financial health checklist, CNMC clears every major threshold with ease. Gearing sits at a microscopic 2.0% and the balance sheet holds a net cash position. The company also boasts a healthy Altman Z-score of 8.40 and strong free cash flow. The balance sheet is undoubtedly a mathematical fortress. But a fortress sitting behind a 118.8% entry premium is a fortress you cannot afford to live in as a retail investor. This is where the dividend arithmetic breaks down completely for the Singaporean retiree. We do not just look at absolute yield. We measure every asset against my forensic floor of 4.7%. While DBS passes with a 6.33% yield, CNMC is a clear yield trap at a dismal 0.53%. And both the Spider Gold shares and UOB Gold Savings account fail completely, offering a flat 0% return on your capital. Take a hard look at that OCBC figure. At 3.57%, a cornerstone of the Singapore sanctuary has officially fallen below the minimum yield hurdle. When even our local banks start to squeeze the yield, the retiree's margin for error disappears entirely. You cannot afford to park 20% of your portfolio in gold earning 0%, while your safe alternatives also begin to lean out. In the Kopitiam of Singapore finance, the free coffee is gone. This is a severe concentration warning. With one leg of the bank trio wobbling, the burden on your remaining high-fidelity yielders just got much heavier. For this audit, I apply a conservative floor of 3.2% plus 150 basis points of mandatory risk premium, bringing our total hurdle to 4.7%. We audit for the storm, not just the sunny day. While the T-bill sits at 1.47%, I do not lower my standards to match a temporary market dip. Spider Gold represents a negative carry of 147 basis points. You are paying 1.47% in lost interest just to hope a yellow metal keeps going up in price. Turning to the valuation, the MRT door paradox is in full effect here. At 1.51 Singapore dollars, the market sprints to get into CNMC, but the forensic floor sits miles below. The peer comparison highlights a stark forensic gap. CNMC trades at a 118.8% premium to its Investing Pro fair value of 0.69 Singapore dollars. This is not a logical investment based on fundamentals. This is a vanity purchase driven by narrative rather than data. Look across that peer table and ask one simple question. Which of these names would you be comfortable holding if gold prices mean reverted by 15% tomorrow? CNMC's paper fortress would crack first. There is no margin of safety, only the assumption that the gold bull run is a permanent law of nature. Even Fortress Minerals, trading closer to intrinsic value, only offers a 2.04% yield, missing the hurdle by 266 basis points. The sector average yield is barely above a fixed deposit. When you chase the shiny metal at cycle highs, you are not buying safety, you are buying the story. And stories do not pay your utility bills in Jurong. Here is the bottom line forensic stance. For the 62-year-old in Toa Payoh managing their SRS drawdown, gold at these levels is a structural threat to your lifestyle. The Spider Gold counter triggers our watchlist warning. It is a non-interest-bearing luxury sitting at a record price premium, and CNMC Gold Mine is a textbook yield trap. You accept a 0.53% yield on an asset trading at more than double its fair value, taking on massive capital destruction risk. If gold prices mean revert by just 10%, your capital loss on a name like CNMC wipes out more than 20 years of those dividends in a single afternoon. With OCBC failing our screens at 3.57%, the sanctuary status of the bank trio is fractured. Your focus must shift to high-fidelity yielders like DBS at 6.33% to offset the inflation MAS is now formally forecasting. Gold is not yield, gold is insurance. And when your insurance costs 3,300 Singapore dollars a year in lost income, you are overinsured and underfunded. If you want a full forensic breakdown of exactly where your SRS capital should be positioned to safely beat a 2.5% inflation environment, that analysis is live right now for members of Iggy's elite investors. The forensic portfolio tracking is already running, giving you zero-day access to specific inflation-beating strategies before the wider retail market reacts to the news. The only question left is whether your capital is actually keeping up with the rising cost of living or quietly evaporating. You are here at the end of this breakdown because you do not want random copy tips or superficial market hype. You want the absolute forensic truth before you commit a single dollar of your hard-earned capital. And that tells me exactly what kind of investor you are. You understand that protecting your downside is the only way to survive the Singapore market over the long term. And you refuse to follow the retail crowd blindly into overpriced assets just because they dominate the headlines. Every financial decision you make needs a foundation built on data, not narrative. Especially when the macro environment shifts beneath your feet, yield traps like CNMC and non-yielding assets like physical gold will quietly erode your retirement if you are not paying close attention. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access link in the description. The red flags were always there. Do not wait for the 7-day embargo window to lift while your portfolio bleeds yield. Join Iggy's elite investors via the link in the description to secure your capital. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.